The latest reading of India's factory output is bound to leave industry watchers worried. Capital goods output, for example, saw a drop of 20% in the September period. Commendable then that THERMAX managed to post a double-digit revenue growth in the second quarter. Order booking also rose nearly 30%. So the glass half full or a glass half empty, whichever you look at it. The question is, can the trend hold or should one be worried about the lower order book? Let's ask the company's MD and CEO, Mr. MS Unnikrishnan, who joins us right now from Pune. Mr. Unnikrishnan, good having you. Thanks for joining in. How would you look at your results? A glass half full or a glass half empty?
Well, I'm a positive, optimistic person, so I always look at the half full side, not the half empty side. Difficulties are there in the market. We cannot wish away the difficulties of the market. But in such a circumstances, there are possibilities of you performing to your best ability. Order conclusions have come down in the market. However, we have been able to register a 28% improvement in our order intake for the quarter. And certainly, I need to be admitting that there was one major order worth around 470 crore, which is included in this one, an FGD order for one of the power plants. But even if I were to take part of that as a windfall, still it is a better performance than the last year's same quarter. There are sectors which aren't doing too well, but there are sectors where people are investing in the country also. I may not want to name them, but certainly the sectors I can specifically talk about are the food processing, dairy, alcohol, and many of them which are from the international investors. There are capacity building happening. They aren't unduly worried about in a country like India where consumption has come down. But consumption come down is not going to be permanent. In a country where the population is growing, lifestyle is changing, consumption are going to catch back once the sentiments improve. So projects normally would take anywhere from 1 to maybe 3 years for completion. So investment is happening. So it is not such a negative scenario, Neeraj, in my opinion, as far as order intake is concerned. Yeah, in fact, if I have to talk about international intake of orders for the current quarter, had not been very satisfactory. What we are reading is only about India, but international markets are also not building in capacity with uncertainties prevailing, trade war equivalent, a number of things prevailing, uncertainty, political uncertainty. So internationally also the order finalizations aren't looking too good. But overall, it had been a good quarter on all the numbers. That's on top. The top line also, we had been able to rise by 12% at the back of decent enough order carry forward. And that if I were to keep away the one-time impact related to our, the deferred tax which we had taken back onto the balance sheet because we are opting for the new tax regime, 22% plus the cess put together impact will be around 25.1 versus what our effective tax rate had been hovering between 35 to 36%, which will certainly fetch this company at 10% tax saving for the future. So we have opted to take it, and the hit is approximately 70 crore between the PBT and the PAT. So that if I were to add back, and the one-time 27 plus crores of rupees which we have had provisions available, it is a written off on the balance sheet, which will show an increase in the expenses. It has been an operationally good quarter also. So that's the overall take on from my side, Neeraj.
Yeah, it certainly has been. So just a two-part question to that. Just first, for accounting sake, you reckon that next quarter onwards, because of the lower tax numbers that you would be subject to or you would take on, the bottom line expansion would largely be faster or higher than the top line expansion?
Should be from the current numbers on account of the fact that next quarter onwards, the incidence of tax on the balance sheet will be limited to 25.12%. Whereas you would have seen if you have to go back in the past, maybe 8 or 10 quarters, we are between 34 to 36%. So that 9-10% differential will be adding on to the net profits of the company next quarter onwards.
Okay. The Q2 order booking has risen healthily, even though the order book may have come down a little bit. My question is, do you reckon that the pace of order inflows compared to the execution that a large company like THERMAX does, you would still be net better off on the order backlog quarter after quarter for the next 2 or 3, or is it difficult to predict that right now looking at the challenges?
A quarter more is visible, but beyond that visibilities can't be spoken because the pace of finalizations necessarily has come down. See, inquiries are there in the market, but there is no sense of urgency perceivable or visible for concluding orders from anybody at this point of time. And because in any case, they can afford to be delaying. There are lots of my customers who have very good balance sheets available. Unleveraged, part leverage, version leverage capabilities are available. And for them, debt is also available. And expansion programs were conceived. But going ahead and signing on the check is something which is getting delayed right now. So because of which I may not want to make a comment right now about how would it pan out. See, there I would look at India behaves part locally and part globally. The local part is going to be picking back. I'm certain about the fact that because inaction related to capacity building will impact everybody. So as say even auto industry was crying for all the while for quite a number of quarters, but I understand month of October most of the people reported a little better in terms of order intake or maybe their sales. And progressively they'll turn around maybe in a 1 year period of time. Once they turn around the auto ancillaries and then the carbon black, the tire industry, all of them will start again going back to that. So I had orders from, say, the tire industry, three of the larger guys, the larger investment. All of them told me, let's go slow. And the first project which is taken up, we are completing. But the second, third one, in all the case, what they mentioned is let's wait for maybe 6 months to 9 months. So in my opinion, things will turn around for the consumption side. I mean, Indians can't be telling that we'll consume much lower. It's really an uncertainty which is caused by n number of reasons. But the global cues is something which is beyond prediction of anybody. There are pluses Indian companies have, say, going to be having it with the China-America trade war. But Chinese have to dump their material somewhere. So in the global competition, we find Chinese very, very aggressive in pricing in Europe, in Southeast Asia. Wherever projects are getting concluded, they become very aggressive on the prices. But in any case, companies like us always got used to fighting with Chinese who always had a lower price. So with the current thing, they can reduce the price by another 5%. That is it. So my competitive edge would have come down by that level, but we'll have to work extra. But there is a positive feeler I am getting. At least in the advanced world, Indian companies can do better, including THERMAX.
Which is quite awesome to hear. Just one last question, Mr. Unnikrishnan. Since you spoke about how the domestic scenario might look okay, and a couple and sectors that you spoke about are not something that I've heard you speak about before, are these large ticket orders or a string of pearl kind of order inflow? And therefore, do they come at the same kind of IRRs or do they come at slightly lower IRRs?
These sectors will be low ticket size orders. They won't be hundreds of crores of projects. It will be a couple of crores, the kind of size projects. Margins can be the same as what you would earn in any other larger order also over here. Because we as a company will have a preferential pricing available from them because our product is far superior than what my competitors do provide. So their margin pressure will be there, but won't be a reduction substantial.
Okay, Mr. Unnikrishnan, great to hear from you and great to hear this tone of optimism. Hopefully it turns around even sooner than you are anticipating because it's great for the markets as well. Thanks for joining in today.
Thank you.
That's Mr. MS Unnikrishnan of THERMAX. Now, the next guest and a very special conversation with Aarti Industries. Simply because specialty chemicals has been on a bit of a tear. I mean, the Indian consumer is holding back for spending for some time, and it's reflecting on the books of all the big consumer companies. The pain has spread to the suppliers. I mean, Aarti Industries saw its revenue decline for the first time in nearly 4 years. The question is that a one-off, or is this a slightly disturbing trend? Somebody who calls a spade, Mr. Rajendra Gogri. He's the chairman and managing director of Aarti Industries, joins us right now on the show to talk about this. Mr. Gogri, good having you. Thanks much for joining in. We're not used to seeing this. Specialty chemical companies and leaders in that space like you and a couple of others posting numbers which are slightly off. So therefore, I want to hear from you what happened in the quarter on the revenue side and how do you think the next couple of quarters could look like?
Yeah, actually our last year's YOY are not totally comparable because we had another division, surfactant division, which was part of that in the last year's second quarter. So after you adjust for that, still there is about overall 17% decline in top line. As you are aware, we have a raw material pass-through model. So about 7% of that impact came because of the raw material. decrease in raw material prices. And also now we have moved more towards value-added products. So our value-added composition, which was like 30-70, that value-added has moved from 70 to 75 compared to base chemicals. So these are a couple of reasons for drop in top line. And as we had mentioned, a couple of sectors are relatively slower, which is on US agrochemicals and globally on automobile sector. So these two sectors are still having some weaknesses.
Mr. Gogri, I'm just trying to put the pieces into perspective. All through, almost everybody who tracks this space and your company talks about how there is a bit of a perpetual element to the kind of growth that companies like yours will show, because we are still at a nascent stage on the global arena. And China was out of the window. There were some fires which would have resulted in some benefits to companies like yours as well. How is that, the entire picture playing out? How has it played out in the quarter gone by? Then I would want to come to the margins as well. But first, this big macro question.
Yeah, big macro question, overall structurally, the cost in India is now better because the environmental costs are at par everywhere, whether it's India or China. And the Chinese labor cost has increased to double US. And second thing, because of this disruption, there is a lot of appetite for sourcing from India. So that remains intact, and there is one more added factor is now between trade war between US and China. Under that circumstances, India becomes the best destination to manufacture for all the market, whether it's US, China, or Europe or other Asia. As far as the disruptions are concerned, that generally are moving from product to product in China, where because of either the safety or environment, some shortages are created, and that gives a kind of a short-term spike for various products, and which over a period then again gets adjusted. But generally they get adjusted at a higher level.
Okay, so Mr. Gogri, are you suggesting that while these disruptions are on, you're utilizing this opportunity to increase your contribution of the high margin products, and therefore the focus in the intermediate period is not on enhancing the top line but enhancing the margin capability of the company?
Yeah, in general, we'll have more and more value-added products. So, per rupee sales, the margins will increase. As you see, one of the contract which we have signed, where the EBITDA margin is going to be 40%. So, as you move more towards value-added, the percentage margins are going to improve.
Yeah,
even
but
at the constant raw material prices.
Yeah, but could that come? I'm just trying to figure out that would we see over the next 2 or 3 or 4 quarters an Aarti Industries performance wherein the management itself is focusing not as much on the top line growth as it is on improving the margins and profitability and return ratios?
Yeah, basically that will be always an endeavor, to go more value-added products. So once you have more and more value-added products, the absolute margin becomes important. So margin to top line, if it is higher, actually it helps you in working capital. So generally top line will not be a much important factor for us to track. It will be more on overall volumes and the margins.
You've beaten the margins very comfortably. The Bloomberg estimates, Mr. Gogri, were at 20.4%. You've come in at 23.4%, which is a substantial jump from on a YOY basis. Is the new normal closer to 20 to 23% for you as a company consolidated?
Yeah, I think it will be around that level. Again, the raw material prices gives an impact, but overall in general, structurally the margins are going to be higher, and because now we also hived up that surfactant business, which was a low margin business. So in general, will be like kind of those numbers, 22 around those numbers for margin.
Okay, but then therefore one more question out here, Mr. Gogri, would be that this revenue and the PAT guidance revision that you've done for FY20, while the focus is on margins and margins would be higher, you've still brought it down, the broad 12 to 20% PAT growth range to about 12% or lower. Is this a situation only restricted till FY20, and or could it percolate into FY21 as well?
No, FY21 there'll be we expect a substantial growth again because of our new projects and everything getting kicked in. So this guidance was basically for looking at these two sectors which I mentioned, which had showed some weaknesses. And but the US agrochemical also was because of the weather situation. So we expect in FY21 that to correct itself. And we'll definitely see both volume margin jump in FY21.
Okay, which is good to know. Final couple of questions, Mr. Gogri, and one of them is with regards to the long-term contracts that you sign. Now, you're doing it one of a kind. I don't see too many other companies doing that. As if my memory serves me right, you have 2 or 3 of these 10-year, 15-year contracts. Anything else that you've signed in the quarter, or anything else that you're looking to get signed into in the next couple of months in the current quarter?
So we had 3 contracts we have signed. 2 of them are 10 years and one is 20 years. So in general, we have been always trying to develop more closer tie-up and businesses. But these were kind of a 10 years, so we had to declare to the stock market. And as and when if there are long-term contracts, we will come to stock market to know where we have to disclose.
Okay. My final question, Mr. Gogri, could anything change this numbers or the guidance that you've given for FY20, either on the upside or on the downside? Are there any possibilities, or would you reckon this is a safe assumption of what you will do for FY20?
Yeah, FY20, we are looking around, lower double-digit number, basically.
But you're confident that that will be achieved? There won't be any disruptions to that number also?
Yeah, as of now, we don't see any issues.
Okay. Well, we wish you all the best for that and more, Mr. Gogri. Thank you so much for taking the time out and speaking to us at BloombergQuint. Really appreciate your time.
Thank you.
That's the view from Aarti Industries, and revised the guidance downwards, but optimistic of clocking in much higher margins than the previous trajectory. 22 or 23% is what he said is the new normal, and no longer the 18 to 20% trajectory that they had. Do watch out. The stock should be mildly soft, but maybe FY21 onwards, the numbers could look better. But with that, it's a wrap on this leg of Indian Open. Thanks so much for watching. Stay tuned. The FNO show takes forward the action on the other side.